Hey, let's clarify something important here. SP or systematic investment plan is not a separate investment option. It's a method of investing in mutual funds. So, the real question is SP versus lump sum investment in mutual funds. Now, choosing between the two depends on your preferences and financial goals. SIP has its pros. It provides disciplined and regular investing, and it helps mitigate the impact of market volatility through rupee cost averaging. But here's the catch: it may not fully take advantage of market lows compared to lump sum investing during market downturns. On the other hand, lump sum investment in mutual funds offers immediate exposure to market returns. And if the market performs well, it has the potential for higher returns. But here's the downside: it exposes your entire investment to market fluctuations at a single point in time, which can be riskier in volatile markets. So the choice really depends on your risk tolerance, investment horizon, and preferences. Some prefer SIPs for a disciplined approach, while others opt for lump sum investments based on market conditions and their financial situation. And hey, diversification across both strategies is also an option. But remember, it's always advisable to consult with a financial advisor to align your investment approach with your specific goals and risk tolerance. So make a smart choice and invest wisely.